What's up? In this next episode of Real Estate Simplified, I'm going to give you behind the scenes access to the Kahlas making a home purchase for themselves. This is our second home. It is going to be our new primary residence, already is our new primary residence up in Frisco, Texas. So this next episode is going to be all about the home buying process for us personally. Obviously, if you've listened to or watched any of the videos that I put up for Real Estate Simplified, you get to hear about the experience from the realtor's perspective. Well, now you're going to get it from my perspective as a buyer myself. So hopefully this is insightful and there's some nuggets in here that you can take away. You can maybe relate to some of the stuff that I'm talking about from a buyer perspective, or maybe it's some new stuff that you haven't heard or maybe even considered. So I do hope you enjoy this video. We've been in the house for a little over a month now, so we're still super excited about it. I'm in my home office right now. It's actually a home office. It's not a secondary bedroom where the queen size bed is pushed off to one side and the desk is on the other wall. So I'll talk a little bit about that as far as things that we were looking for in a new home. So I hope you enjoy, and I'll touch base with you right after the video ends.
The mission of this journey is to help people that are considering a move to the real estate industry, have been doing this for a short period of time, or who simply want to know more about real estate and the behind the scenes ins and outs of the highs and sometimes lows of this industry. Welcome to Real Estate Simplified.
So I have some news.
What news do you have, bro? What news do you have?
We had kind of talked about it a little bit off camera before we started talking for the episode. I got under contract on a house. Yay! So we will be moving to Frisco ourselves. December 15th is the close date.
That's awesome.
Got the inspection done today. Nothing of too much concern.
Right.
No mold, no water damage, no leaky
termites.
Roofs, no termites, none of the red flags. So I wanted to talk about that because in previous episodes, we kind of talk about practice what we preach, and if we could rent out our house, that's what we would do, and here's why we would do it. If we wanted to buy now, if that's something that we needed to do right now, we would. And here are the reasons why.
Well, let's go step by step through the process.
Yeah.
Like before you started even looking, what is it that you had to do to get yourself in shape to go out and take a look?
Well, I mean, I guess that kind of started with just our everyday responsibilities, our everyday mindset of having a good credit score, having a savings account, not blowing all of our funds on the vacations and the immediate gratification. I have to be honest, there's still the times that we'll get some crumble cookies or we'll go out to eat, or the wife will get a few more sweaters from Free People.
So there was a couple of Applebee's in there.
Yeah. A little bit of Applebee's, a little bit of Chili's. Not necessarily beans and rice and pinching pennies, but having a savings account, paying off the credit card every single month, and that's something that you should be doing if you're not wanting to buy.
But why is that important? I mean, they give you 15 days, 30 days grace period.
Sure.
It's like you can float things. Why was it important in you preparing yourself to get a house? To make sure all of that was in order.
Well, when you are taking care of those things and you are being responsible even before thinking about it, you have to get the pre-qualification, right? Unless you're paying cash, and a lot of people aren't paying cash for homes, especially first-time home buyers, or even people that are going to that second, third, fourth home, where they're needing to upgrade a little bit. Maybe they want the pool, they want the extra bedroom for the additional kid that's coming. A lot of people aren't paying cash unless they're coming from another state where the housing market is through the roof. They've got a ton of equity, they can sell that, and they've got a lot of leverage in the way of cash. or they might be downsizing, right? So you're coming from a 4,000 square foot home. You're now an empty nester. You've had that home for 30 years. You bought it for $100,000, and now it's $800,000 or something.
And now you got cash, so there's no problem.
And now you got cash, and you could downsize to a 1,500, 2,000 square foot home. You can pay cash, right? But the majority of consumers aren't doing that.
Right.
So you have to get a mortgage. You have to get a loan in order to afford that property that you want to get into. And when you go through the pre-qualification process, they run they run your credit. They do a hard credit line pool or run, whatever you want to call it. And I know there are some misconceptions or just incorrect data that's out there about, well, don't run my credit because it's going to hurt my score.
Right.
It impacts it by 2 to 5 points at the most. Normally it's 2 to 3 points.
Right. And one of the things is when mortgage companies are pulling, they have what's called a soft pull.
They can do that before they. It's like, okay, do you really want to? Because based on what you're telling me, your debt to income, any foreclosures or any evictions, bankruptcies, anything like that, they can see it all before they do the hard pull.
Right.
Absolutely, without impacting it. So they could have a general idea, and they could even do that for a pre-qualification. Right. More of that soft. Hey, we've kind of checked some things out. Yeah. They're looking good. Yeah. As long as there's not anything that they didn't tell us, they can afford this amount for a home with this down payment and potentially this mortgage rate or interest rate. But in order to get a good interest rate, in order to maybe have a lower down payment, maybe have a even possibility of a certain amount that we could qualify to borrow from a bank or a lender.
Now
we had to be responsible.
Yeah. So on that, I did want to ask you a question because it's like you're a realtor, your wife's a doctor, right? So and she's
we're in a house of learned doctors.
This is a house of learned doctors. You're not a doctor.
But she's a relatively young doctor. So
yes.
Being a young
relatively, yes.
Yes, being a young doctor means that there's still some educational bills hanging around.
Yeah.
So how do you
you're getting the skeletons out of the closet, huh?
But it's something that come on.
Sure.
The American dream is you go to school, you go to college, you get out, you get a job, and you buy a house. But most people who go to college and then they get the job and they go to buy the house, they go, oh yeah, you got this student loan.
Called student loan. And that whole student loan forgiveness thing, I don't really know if that's going to work out.
I don't know. It's more like a Domino's forgiveness. I don't think it's a real.
No. I've seen some things recently too where some courts are saying, this isn't actually going to happen.
It's like, until the money's in the pocket, it's a nice thought.
Yeah, let's go ahead and assume you still have the student loans. Which are considered debts.
Yeah. And, even with student loan forgiveness, it's only 20 G's.
Right.
I don't know anybody got their doctorate for 20 G's.
No.
I'm just saying.
Right.
So there's still some.
Yeah, so at a high level, we had initially planned to have both of us on the qualifications, debt to income, go ahead and run the credit with both of us on there. It would just be easier that way. I mean, we're in the state of Texas, we're married, we've been living in the same house for X amount of time. Everything's kind of split down the middle anyways. Like even if she's not on the loan, she's going to have to be at closing and sign documents that it's split 50-50. But when it comes to qualification, our lender looked at both of our debts, both of our incomes, our businesses as well. And based on her student loans that are substantially higher than maybe even some people that went to a state school for 4 years. You got the 4-year undergrad and then 4 years of doctorate program. That's a lot more that you have to pay back. And because of that, we wouldn't have qualified for the same amount of a loan. We wouldn't have qualified for the same amount of home.
So you guys had to make a quality decision in the family.
Yes.
To say, hey, we're just going to go on one income.
Yep.
We're going to get it.
We're going to qualify on one income.
Gotcha.
And we qualified for more because my debt, and I think the majority of people, to your point, right, the American dream, go to college. Most people don't have a lot of other debt coming out at 22, 23, 30 years old.
Right.
Now you get a little bit older, that high school car that you were gifted by your parents is the college car and it survives. And then you need to get a new car. And so you start to get a $30,000, $40,000, $50,000 car note. Right. So those debts can come up.
Can stack up. Right.
Yeah. But for a lot of people, it is just the student loans for the most part. If they decided to go the route of the continuing education.
Right.
But yeah, so we ran the numbers.
It's not something that stopped you. You did navigate a way around it.
Yep.
Because you looked at what your income was.
Right.
And the kind of place that you wanted to be in.
Yes.
Off of one income, you could do that. Now, it's not one income that's paying for it.
Yeah.
But one income could
not one income that's paying for it once we close. So that'll be another piece of the conversation too later on, is because since we both own our own businesses, we can do owner's draws, right, from our businesses. So they look at how our businesses do the income tax, the tax returns from the businesses as well as our personal, and based on that, numbers generated. Didn't really work out with the debt to income with both of us on there, so they just looked at my personal income and my business income, our tax return, and based on that, qualified for an amount that we were saying, okay, we could be competitive, and we could find something that fits our needs right now. In this.
Okay, so let's look at your needs. When you were saying your needs, what were your needs going into looking to buy a house?
Yeah, so location was huge for us. So the house that we found, it is less than a mile from my wife's practice. So if she wanted to ride a bike to work, if we wanted to invest in a family golf cart, and she could, street legal golf cart, she could drive that to work, or just in general, it's literally 5 minutes from her office, which was it was a bit of a constraint on her, even though she goes into the office 2 days a week. Our daughter stays with her parents one night of the week to kind of have the sleepover experience, slumber party experience.
And where are her parents?
In Allen.
Oh wow.
Yeah.
So it's close.
That's an hour drive from where we're currently at.
Right.
And
it's 20 minutes from here.
Right. Exactly.
It's a big difference.
So big difference.
Right.
A lot of her family's up here. My business is up here for the most part.
So we're talking about close to work, close to family.
Yep.
What other things were important in looking for a place?
Close to work, close to family. I mean, honestly, something that could potentially be move-in ready, but something that we also could put our own fingerprints on, could make it our own, but not something that was the tear down, not something that was, okay, it's kind of a similar situation where we currently live, 1,700 square feet, 3-bed, 2-bath, but no designated office area, or no formal dining, or no large covered back patio.
So your list.
I'm looking at features, too.
So your list became close to family, close to work, have an office space, formal dining space.
Yep, even considered formal office, right? Because as we walk in, you turn to the right, that is truly an office. There's a built-in desk.
Oh, cool.
On one side, so it's basically a permanent fixture in there. So if we wanted to convert it to a 4th bedroom, you could certainly do that.
It would just have a desk.
Yeah, and if you wanted to go a little bit farther, you could rip the desk out and change out the doors, because it's more of a French style door, and it's got windows on, glass panes on there, so it definitely doesn't have the privacy of a bedroom. But even if guests come to visit, or
it's a perfect guest room, because it's like
could be a perfect guest room. Right? You put a couch in there that's pulled out, ready to go. Nice blow up mattress.
And they won't want to stay too long, because it's like, I don't really have privacy.
And we probably wouldn't want them to stay too long.
Right.
Don't you have your own home? You can stay with us if it means that you're here looking for a home in the area. How about that? There's
And
gonna be a
we'll
little caveat.
look in on you while you're staying
That's right,
here.
Here's Johnny.
Rise
Even
and
though the door is
shine.
closed.
Looks like your eyes are open. Here's some coffee.
So then what happened next? Like you got your approval, right?
Mm-hmm.
And then what was, so when you were looking for somebody to finance,
Yeah.
to do finance with, what were you, because, you know, most people don't go and buy a house every day. You know what I'm saying? And it's
Correct.
like, you know, I could say, where
It's
do
not
you
like going in the Chick-fil-A line.
No. Or getting your hair cut.
Right.
You know what I'm saying? Or it's like, where do you like to go to eat? You know, it's like you got a couple of options.
Yeah, you got your areas. Yeah.
But, you know, it's like a lot of people don't know what they don't know.
Sure.
So what made you, one, pick the finance company that you picked? What were the important?
So they're one of the two preferred lenders that I will refer my clients to.
Mm-hmm.
So I know them from that. I have experience with that. My clients do as well. Great experience.
So why are they your preferred lender? Because they bought you lunch?
No. I mean, long story short is either they were referred to me by another realtor that's done business with them, or somebody that I know and trust from a title company that I've done business with and that I trust. Similar business mindset, similar business philosophy.
Gotcha.
Kind of have the same values as well. Somebody that I would enjoy going to lunch with, taking to lunch,
right. So
playing golf.
When you say similar values, what do you think are like the top 3 values that are important to you that they share?
Yeah. You know, how we vote. I just figured I'd get a reaction out of you. I wanted to see who they voted for in this past
Libertarians
election.
never win, bro. No.
Hey, it's tough out there. It's tough out there for those independents, man. It is tough for those free thinkers. Those true free thinkers. Not the people that think they're free thinkers. I'm like, you sound a lot like X. I don't know if that's free. Somebody's living rent free in your head.
Right.
But I mean, values in the sense of they look at the markets. They are students of real estate. They're students of trends, insights. We're texting, we're talking, we're investing in each other, asking each other questions about what's going on. Whether it's in real estate, whether it's just in business as a whole. What are my clients hearing, saying, and vice versa. So that was kind of a value for me, is just kind of being a student of real estate and being as well versed as I can be. Another is not being more of a salesperson, I think is huge for me. Both of my preferred lenders, they're, hey, I think this is the right time. I don't think this is the right time, whether it might be. And we were even having a conversation about locking the rate and going back to being a student. And then value 2, someone that's just going to be real. Somebody's going to say, hey, here's my insight, but you ultimately make the decision. But I'm going to provide you this information.
So
sound counsel.
Education, expertise, and then what's the third? What do you say?
Well, let me finish on the second one. It's just, you know, not trying to be too much of a commission breath. Like, let's just get this thing done. The market kind of shifted the last couple of days as far as basis points, as far as potentially lower interest rates. And we had the conversation yesterday, and it was like 7.8 if we would have locked a 30-year fixed conventional yesterday. But based on being a student of the market, based on just having an open, honest conversations, like, hey, let's get to Friday, let's get to Monday, let's see what happens. I could lock this thing, or, you know, your closing date is the 15th, and that's 35 days. You can only do a 30-day lock or a 45-day lock. I'm willing to eat those 5 days to get this done. If we think that this is going to be the lowest rate we can get in the next week, but based on what I'm seeing, it could potentially go down. So let's see what happens.
Oh, good.
So, right, having that open, honest conversation rather than let's just get it done.
Right.
Called about it earlier today, trending the right way. I'll look at it again first thing Monday morning, reach out to you. Right? So there's no, let's just lock this thing in. I'm done with you. They can move on.
Gotcha.
And then, I guess third thing that I look for is accessibility. Like for me, it might be a little bit different for, well, not really. I don't think it'd be different because they've done this with both of my preferred lenders have done this with current clients and past clients. They're accessible. They have their office number, they have their personal cell number, they have email, and they're also including me. So very open communication, very consistent communication, real-time communication. So those three things I've seen with my clients that I refer to them, and that's been great for me as a client too.
As a buyer, it was important: education, expertise, and communication.
Absolutely.
And you do this every day. Right. So these are qualities that you would say, hey, if you're looking to buy, you need to make sure that your team is doing this. And the lender is definitely a strong part of your team.
Absolutely. Yeah. And even on the accessibility part, the communication part, the third one, I want them to expect them to reach out to, if I'm on the buyer side, reach out to the listing agent. Call them. Say, hey, just wanted to follow up on the email. Right. If in this situation, I'd be the buyer's agent. And I would include whoever the lender is on the email.
Why does that make a difference?
It shows that they're serious. It shows the buyer is serious. And then I'll also say in the email, expect Melissa to reach out about the financing to confirm not only the pre-qualification letter, but also answer any questions that you may have.
Cool.
So I've done that with every single one of my buyers, and I will also reach out to that lender and say, hey, how was the conversation with the listing agent? Not, hey, have you called them? It's, hey, how was the conversation? Right, because it's an expectation.
Right.
I want to do the same thing for them, and that's my expectation, not only as a buyer's agent, but also as the buyer.
As a buyer.
And that's not as crucial. It's still important. It's not as crucial now with the market leveling off a little bit, and there's not 20 offers on one home over list price, but it's still important. Because if you're a listing agent and they're doing their job right, doing their due diligence, they should also be reaching out to the lender. So if the lender can beat them to it, it shows a huge positive for that buyer.
You got your loan in place.
Yep.
You got your checklist of what you wanted.
Yeah. Well, and I want to speak to the loan in place a little bit more, or kind of drive something home a little bit more too. We weren't really actively looking. It was just a conversation, informal conversation in our house. We knew once we had 2 years in both of our businesses, we have 2 years of tax returns. That's kind of what we knew we needed as just a base level of understanding what we could qualify for. We had been thinking about even potentially buying land, or having a few acres with a home on it, or just buying raw land and developing it and putting a homestead on there. So because of that, because we had enough informal conversations and we did get those tax returns, we went ahead and got a pre-qualification. It doesn't hurt you to go ahead and get a pre-qualification and just know. A lot of times, and you've experienced this, we'll have conversations with potential clients or current clients that they want to buy, and great. Have you been pre-qualified? Yes, no, whatever the answer is, right?
Right.
Regardless of what the answer is, regardless of if they actually have, if we start showing them homes and they like one of those homes enough to put an offer in, well, now you have to show your hand. The river has come. If we're playing Texas Hold'em,
right?
The river's hit.
Right.
Everybody has bet.
Right.
You call
Right.
my raise.
Right.
Now we got to show our cards.
Right.
Right. The river is you love this house. You want to put an offer in. Great. Show me your cards.
Right.
Shoot me over your pre-qualification.
Right. Because without a pre-qualification,
it doesn't. It's nothing.
You're not holding anything.
It's nothing.
Right. Right.
Even in a buyer's market, it's nothing.
You don't even have a low pair.
No.
Yeah.
You bluffed.
Right.
You bluffed with a 7 deuce, and there's a straight on the board.
There's a straight on the board. Yeah. You're not winning.
You're out.
Yeah.
And it's going to show.
That's a great analogy.
It's going to show. You have to show your hand.
Right.
So even if you're just informally having conversations, even if you're informally thinking, right? If you don't have to communicate with a spouse, if you're just buying a home on your own, or even buying investment properties, and you're thinking about getting into that, go ahead and exactly what you said with a lender. They can do a soft pull. They can just high level income, debt, get an understanding of kind of where you're at.
You are. Yeah.
They can give you general information.
So let me ask you a question. Did you have in your mind, hey, this is how much we want to be paying in a mortgage? So
yes and no. I kind of had a general idea. Being in the line of work that I'm in, that wasn't really a huge deciding factor. Knowing that we got qualified on my income. So wife's income is not included in that at all. So say for instance, we can qualify for we like using $500,000 home. So we can qualify for a $500,000 home just on my income, and say the monthly payments are $3,500. If things get tight with just my income, we have to remember that you have a second income. You have a dual income family. So that's important to also think about too. But I think what buyers do need to consider as well is, you say your mortgage again is $3,500. That includes, if you don't have 20% down, that includes your private mortgage insurance, that includes your property taxes, that includes your interest. So there's a difference in just your principal and those 3 additional items as well. Because my principal, if I have a $3,500 total payment, might only be $1,000 or $1,500
out of that 35 that you're paying.
Correct.
Right.
Yeah.
Right.
So what's nice about, so even if it's 3,500
months. No. Anyway.
Something. Yeah. It'll feel like 500 months. But I mean, just like some of the strategies that we talked about, like with this current home that we have that we're not selling, which we'll talk a little bit about that.
Right.
We locked in a low interest rate back in, I think we did that in 2020. So really before,
so like 2% or something like
that. It's in low 3s, but it was before it really got down to the 2s.
Yeah, it's like,
but still, it's like 3.35%.
You get skim milk interest rates.
Yeah,
like...
I'm drinking 2% instead of 1%. Like it's still skim.
Right.
I'm still feeling skinny. Right. I feel like I'm being responsible
and very healthy.
That's
there,
right. Yeah, my bones aren't as dense anymore.
Right.
I'm drinking that whole milk.
But the majority of the payment is going towards your principal.
Absolutely. Right. Yeah, and it's so 3.35% on that one. Everything included, it's $1,485. So you have to think about that payment, what we currently have in that home. 3 bed, 2 bath, 1,700 square feet. I mean, basically you're trading up. You just have to really consider, again, going back to those pros of being in that area. Why did we choose this home? Location, proximity to work, friends and family, and just ease of life in general, right? I mean, typically, if I'm driving from our current house to come up here and shoot videos, it's 45 minutes. Now, it'll be 12.
Right.
Times that by 2.
Right.
Because it's there and back.
Right.
It's not just here and then I'm going to sleep on the couch.
Right.
I got to go back home.
Right.
Right? So it's an hour and a half versus 25 minutes.
Right. Right.
So if I have to pay an extra $2,000 a month, if we're using those examples of 3,500 and 1,500, it makes sense.
Yeah, because you're talking quality of life.
Mm-hmm.
It's like you're literally buying a house
Yeah.
to support the quality of life that you want to have.
Well, and what's also important to think about is if you think, so say you get that anticipated monthly payment with taxes, insurance, and principal, all the things added up, $3,500. Okay, you don't want to pay that much? Go look at a house for rent that is similar comps. You're going to rent a house that's 2,700 square feet, basically call it 4 bedrooms if you want to use that office as a 4 bed, 2 bath, granite countertops, HOA. How much are you going to pay a month in rent?
Yeah.
Probably pretty darn close to the same.
$3 grand, 3,500.
Probably pretty darn close to the same.
Yeah, I mean, in the Frisco area, if you're getting a 3-bedroom, 2-bath house,
mm-hmm.
you're starting at 3.
Absolutely.
You're starting at 3.
Yeah, no question.
And then it just goes up from there.
Right.
So, and you're not owning anything.
And that's what I was about to say. And it's not yours.
Yeah.
You're paying somebody else to live there.
Yeah.
Which, granted, we are paying somebody else to live there because it's a mortgage, but it's in my name.
Yeah.
So, and what's also amazing about that is we haven't locked it yet because we already mentioned rates are going down, some basis points, great stuff. Might get in the 6s, probably not. Who knows, right? Low 7 instead of 7, 8.
But you might be able to get an arm.
Maybe. Even the arms right now aren't looking as great as I think. Just go ahead and get a fixed rate and then 6 months later potentially refi.
Right.
When it hopefully is maybe in the 5s.
Right.
But that's what's great about owning is, all right, right now, kind of worst case scenario, it's going to be $3,500 at a 7.8% interest rate, right? Well, in 6 months or 9 to 12 months, it's down in the 5s, and maybe I buy a point. Now it's down 4s.
Right.
I refinance.
Right.
Now that $3,500 payment goes to $2,800.
Same house.
Same exact house, but I've built equity.
Right.
And we haven't talked about this either. We are not putting more than 20% down. So you have the PMI, right? You have the private mortgage insurance, which I think right now it's going to be like $170 a month for that house. So times that by 12, like.
Yeah.
Are you sure you want this house?
2,400. Yeah.
But you refinance in 9 to 12 months, and looking at what the market will potentially do, what the forecast is in North Texas, right? We're talking about local markets, not nationally, local markets. That home, in this example, the $500,000 home, it could now be $550,000.
Oh yeah.
And you had 10% into it, so 50, 550, that 50 and 50 is 100.
Right.
Now
So
you do have over 20%
right.
into it, so you
And
refinance, the PMI falls off,
right.
and you get a lower interest rate.
Right.
So you might be saving $800 a month or $850 a month.
So now that quote unquote 350 is almost under 2.
The 3,500.
I mean,
Yeah,
3,500.
the 3,500
350.
might be 2,000.
Might be 2,000.
Right.
And you're where you want to be. You're living the lifestyle that you want to live. You're doing the kind of things that you want to do.
Absolutely.
Right. As opposed to, oh, one day I'll have.
Yeah. Well, and always, exactly. I mean, that's, yeah. And the complacency. We talked about that, right? The complacency. We already have a house. We're building equity in this home. Remember when we bought it for $140 and now it's worth $340?
Right.
Great.
But it's still not where you're still not living
but
your
we're
best
driving
life.
an hour every day.
But let's talk about that though. Okay, so now you got 2 houses.
Yep.
Right? So what are you doing with the other house?
Yeah, so
paying 2 mortgages?
Well, we had the conversation with our lender. I say I had the conversation with our lender saying, look, I don't want contingencies. I know this home has been on the market for a little over 40 days.
Okay, hold on a second. So contingencies, what do you mean contingencies?
Contingency meaning I will buy this home from you, Mr. Seller. So me, Mr. Buyer, I write into, or my agent writes into the contract. Really, it would be an amendment or an addendum, but I write into my offer saying, love your home, I will present an offer to you for full list price. They're getting excited, right? That's on the first page. They're like, full list price, great. They see, oh, they're going to pay for the title policy and transfer, great. And then they keep scrolling down. Okay, financing, good. They don't need buyer's approval, so they're already pre-approved, great. And then one of those last pages is like, wait, what is this? It's a contingency on buyer will move forward with this as long as they're able to sell their current home. And so a seller sees that.
Why is that, as the seller, why is you selling your home my problem?
It's absolutely your problem if you sign it. Because if I cannot sell my home, a lot of times that's because of financing, right? That's because of the financial debt to income. If you take that equity from this house, or the only way that I can afford this new house that is bigger, more expensive, is to sell my current home that has all this equity that's built up over the last 7 years, and take that equity and put it towards the down payment of this other home. But another piece of that is, okay, well, say you can afford it, but you're still wanting to pull that equity out, or you just don't, you have no desire to have an investment property. You would still have to have potentially a contingency. Or you would have to risk not selling that home and having 2 mortgages. Right. So I could submit it with no contingency because I really want this home really bad. I don't want there to be this contingency that might change their opinion on whether or not they select our offer or accept our offer. And so I say, market's fine. We'll list it at the right price, and surely we can get an offer on that home and close on that before closing on that. You don't know that. Right. So if I'm your realtor, I would strongly advise you to, if you are wanting to sell that home, submit an offer with a contingency, especially if you're clear to me that, or you communicate to me clearly that you do not want 2 mortgages. You're like, okay, based on what you said, then we need to submit a contingency. So I said, look, I don't want one. I don't want a contingency. Is there any way that we can do this? Keep both of them, or do I need to sell the house to have that equity for the down payment? Again, didn't just try to get me off the phone, go ahead and get the pre-approval, just figure it out. It was, well, let me talk to my team. Next day calls, hey, actually, I think in order for y'all to get this house, you need to keep your current residence.
Your lender told you to keep that?
The lender told me.
So that's where education comes in.
He gave me reasons why.
Okay, why did he say?
Yeah, just keep that one.
Because he was going to give you a bigger loan and then make more money?
No. It was, well, you're saying you don't want contingencies, right? If you don't sell this house, that's one way to eliminate the possibility of a contingency. And if you do keep the house, you could turn it into an investment property, which is something I've always wanted to do anyways, and something that we encourage our listeners, buyers, sellers, all the time, right? A great way,
wealth.
Yes, exactly. A great way to become wealthy in any sort of term in America is to have real estate, invest in real estate, and have cash flow, have investment properties. So I've always wanted to do that, but I didn't think that was a possibility because we are moving up. We realized that debt to income ratio, it's only going to be on mine because of the student loans of my wife. So it's like, let's just have a clean cut, get out of here, take the equity, put it into the next home. Right.
But you listen to somebody a little smarter than you.
Yeah, I'm getting better at that. I am getting better at that. That's not something that I came by naturally. That's for sure. But I'm getting better at that, and I wanted to get a better understanding of it. It's like, well, how much do you think you could rent that for? I had already run comps on it too, just kind of the wishful thinking or daydreaming, and it's like, well, yeah, I could probably rent it out for this amount, and based on that, have $600-700 of cash flow every single month on top of the mortgage, because like we had already talked about earlier, mortgage was 3.35%. Here's our mortgage payment based on comps. I can rent it out for this. you're in the black every single month, right? That's an additional $7,200 a year. Obviously, there might be some maintenance and things like that,
Right.
but as far as gross rental income,
not bad.
there you go, right? Not bad, because we
That's
bought
about
the house.
2 tanks of gas in your car, though, right?
Hey, it's 1.5, give or take 1.5.
Right.
But yeah, times are hard on that. So it's still,
but that's awesome. Though.
So that's a huge plus. And in order to not have the contingency, that turns into income. Not immediately. You still have to have 12 months before it turns into more of a true income that I can add to my debt to income ratio. But I am making passive income off of a property that we currently live in that is no longer a contingency, and the $600 additional a month that I'm making off of that, based on what I've already locked into a 12-month lease agreement, I could potentially put that towards the mortgage on the new house if I wanted to, or I could use it however I want. Right.
But what about, them calling you in the middle of the night because the toilet's clogged?
Yeah. I won't answer. But I'll see it first thing in the morning. Or if I do answer, I'll say, just turn the water off. I'll be there in the morning.
But so either you could handle it, or you could get
I could have a property manager. Yeah.
So that would maybe eat into that 600.
It could. Yep. Absolutely.
But so maybe we turn the 6 into 400 or 500.
Yeah.
You're still making money.
You're still in the black.
No headache.
Yep.
Sounds
and
like
that mortgage is still getting paid, and the
equity
it's still appreciating. Equity's still going up.
Where's the downside?
I don't see one.
Okay.
So we're practicing what we're preaching.
Eating your own dog food.
I'm eating my dog food.
Eating your own cooking.
It's real food. It's not store bought.
Right.
It's not that.
It's not packed
gross.
with
You don't really know what kind of shade of brown it is. Dog food.
Right.
It's chicken breast and rice and some bone broth.
Right.
It's yummy.
It's yummy.
Yes.
Coat's looking nice.
I was about to say, it's shiny.
Right.
It's looking good.
That's awesome.
I'm going to live to 20. And my expected age is 14.
Right. That's what I'm talking about.
Yeah. So a lot of pros. But if I would have blindly made decisions, if I would have made decisions on emotion, if I would have not sought counsel, if I wouldn't have had those values in place for those people that I want to surround myself with, whether it's a realtor, a lender, or sound counsel in general, right? People that I trust, I might have just gone ahead and sold that home. And I might have said, well, my only option is to submit an offer with a contingency.
And you might not have gotten it.
I might not be here talking about a home that we just got under contract on.
That's less than a mile from where your wife works.
Right.
Closer to your parents.
Yep.
In the neighborhood that you want to be.
Closer to my work.
Pros.
Yeah.
Hey, that sounds like the way to move.
Yeah.
That sounds like the way to do it, bro.
Yeah. So, and really quick, I wanted to talk about another option that we had briefly discussed off camera, is the possibility of somehow leveraging the buy down program. So we got this home about 50 below what their original list price was.
Wow.
So huge win, right?
Right.
Great time to buy. Still considered by definition a seller's market based on inventory and based on how many buyers are out there, right? We're still at 3 to 4 months of inventory. We'll see what happens in the next few months when interest rates do what they do. Is it going to stay at a seller? Is it going to level out? Who knows? But right now, still by definition, seller's market. But we got something under list price by $50,000. Been on the market a little over 40 days, but I ran comps, did a CMA, comparative market analysis, and based on those comps, it could appraise for anywhere between 580 to 595, 580 on the low side. So because of that, and because of what our offer was and what it got accepted for at 560, what I could do if I wanted to get a lower interest rate, because I don't want to have a higher monthly mortgage payment, is I could say, hey, seller or seller's agent, based on the CMA that I ran, I'm confident that it'll appraise for 580, 585, whatever. Still give myself a little bit of room, but I can say we're willing to offer 570, knowing that it'll appraise for above that. So a lender is never going to give you more money than what the offer price is based on the appraisal, but they'll always only give you, the most they'll give you is what it appraises for.
Right.
So if we had an offer price that got executed at 560 and it comes in at 550, they would only give us 550, right? But if it appraises above,
right,
they'll still give me the 560.
Okay.
They're not going to give you 20 grand just to give you 20 grand.
Yeah, nobody wants to give away money. Right, right.
I mean, some people.
Some people. Yeah, what is it? Mr. Beast?
Some guy that I knew like 2,000 years ago. I think his initials are JC. I don't know.
He was giving away stuff, but
he was telling people to give away too.
right.
Something about a camel and,
and
the eye of a needle.
Right.
I don't know.
Yeah. It's like, who sews anyway? No.
We're not talking about sewing shirts. We're talking about mending soles.
Right? 100%.
Man. So because of that, right? They're not going to give the money away. So they're gonna, if it comes in at 580, executed price is 560. They're still going to give you the 560.
Right.
Or whatever it is. With
they're going to keep
payment.
that. They're going to keep that 20,000 in their pocket.
Well, technically, you're going to keep it.
Right.
Because you have that free equity in the home because you bought under market value.
Right.
But, so I go to Mr. Listing Agent and I say, we're willing to change our offer price to 570 if your sellers are willing to offer a 2-1 buy down on the mortgage rate.
2-1 buy down being?
So 2-1 buy down being, or just buy down program in general, if it's 2-1, it would be for the first year. If your interest rate is 7%, 2% of that would come off. So instead of 7%, it'd be 5%. And then the 1 is for the second year. So if it was 7%, you would do 7 minus 1 would be 6%. So for your first year, as the buyer, your mortgage rate would be 5%. The second year, it'd be 6%. The third year, it would go back up to the original interest rate, 7%. You could refinance at any time. There's no penalty to the buyer.
So let's say this year interest rates are there, up high.
Yeah.
But next year interest rates go to 5.
Refinance.
Refinance.
Yep.
But what happens to whatever money it took to do this 2-1 buy down thingy?
It goes into the equity of the home.
So it doesn't.
Doesn't go back to the seller. The lender doesn't get it. It goes into the equity of the home. So it's already done.
So actually, you're showing the seller a way to utilize that difference, because technically, in a way, that's all money on paper. If they listed, I mean, just using round numbers, we always are using 500,000, right?
Yeah.
So
it's easy.
Yeah, it's
easy enough,
right? We can both do math around that because there's no I in Zillow.
Yes, there is.
Not in Zillow.
An I?
I mean,
we can't get back on this topic.
There's no A.
Sir.
There's no A in Zillow.
That's correct.
There's no A in Zillow.
but there is
anyway,
in Zestimate.
Yeah, there is in Zestimate. But anyway, we're
talking numbers, not letters.
Yeah. I do pictures, daggone it. No. Okay. So, no fun. This is very serious.
Zero fun, sir.
Yeah.
Go on, think. Is it fun?
No, sir.
No.
No, sir.
Absolutely not?
Zero fun, sir.
All right.
But if we wanted to do that in our situation, we could absolutely do that with no additional money out of our pocket to get to the closing table. Right? Because we would still have the same down payment percentage. We would still have a loan to cover the cost. The closing cost would still relatively be the same. I mean, I guess you could say, all right, it'd be an extra few $100s to, you know, based on doing a loan of additional 10,000, but we're not bringing ourselves an additional 10,000 in order for them to offer the buy down. So we could have done that.
Wow. Wow.
To knowing that we got it at 560, and it looks like it has a strong possibility of appraising at 580 to 595.
Wow.
Now, if it's not going to appraise higher, you don't really have that leverage.
Mm-hmm.
But it's a win for the seller. It's basically a wash for the seller. They're not losing money.
Right.
They're getting that additional 10,000 back.
They're
Basically, they're giving you
more,
10,000
right.
in the form of a buy down program.
Right.
From that additional 10,000 that they got at the closing table.
Right. As opposed to having to reduce their price by $10,000.
Correct.
Because it's sat on the market longer.
Yep.
Smart.
Yeah.
That's smart.
So that could have been an option. That's a great option for buyers, especially if sellers are just needing to get out of that house. So if that was the case, they were already out,
Right.
and they had already bought another house closer to family themselves. So they were reducing the price pretty aggressively because they were just ready to be done with it.
Right.
Right? They were in the situation that we were in with, well, would we really want 2 mortgages? Like, I have no interest in having an investment property. I don't want to rent it out. I just, take the equity and go off to my next house.
Right. So now, I mean, you do real estate all the time and everything else like that. And you said you wanted kind of a clean deal, not a lot of contingencies. Inspections are considered contingencies. Did you have the house inspected?
Yeah, so we actually did the inspection this morning. I didn't do the inspection. A licensed inspector did the inspection. But he did that at 8 this morning. We went there at 11 o'clock to do the walkthrough. Really, no red flags came up. There's going to be some minor stuff that we put on a amendment to request certain repairs. Not even going to ask for...
Like a fogged window or...
Yeah, just some minor stuff. Like a GFCI is out, and I think the garage door openers, they're not at the right height, and they don't have the reverse, so we'll get it serviced and working from like a safety standpoint. That's always what I look at for my buyers too. So I want to have the same mindset as my buyers. I'm not going to try to gouge anybody or take advantage of a seller. What I did is what I would encourage my buyers to do as well.
Gotcha.
Safety and health.
So you're under contract. Are you through the option period?
It will be over on Tuesday.
So between now and Tuesday, you could just wake up and be like, "Nah, I'm kidding." And walk out.
Sure could. Yeah, I mean, we have the option period, right? We did a 7-day option period, gotten there pretty quick with the inspection. So yeah, I could certainly wake up tomorrow and have a conversation with the wife, and we could walk away and just lose a couple $100.
Right.
If we wanted to, I guess.
Yeah.
We're not going to.
You're not going to.
Yeah.
So how do you? So now is the time to buy the bass boat? You got approval and all of this other stuff.
Unless you buy it cash, I guess.
You're
but even then,
you're close to Nebraska Furniture Mart. You could go get some new furniture right now.
It's true. Yeah.
So are you going to? Or?
I am not.
Why not?
Well, because that would go against everything that I advise my clients to do. That'd be a little hypocritical.
Yeah. And what would it do to your deal?
It could make it fall through. It could absolutely make it fall through. We could run up the credit card, and that would very negatively impact our credit score, right? So you kind of have brackets of credit scores. Like 800 and above is great. 739 to 799 is good.
Right.
You know, the next one, average, below average, bad. Don't talk to me.
So you don't want to slide down the...
I don't want to slide down to the below average, right? We're kind of in that average to good.
So now in these 30 days, it may not be hot dogs and beans time, but there's no Applebee's and...
It's normal living.
Yeah.
It's just normal living. We're going to still spend the same money that we do at the grocery store.
All right, so the end of the video, if you made it this long, or end of the audio, it kind of got cut off there at the end. We just ran out of time and storage space on the devices that we were using to get the content. But to kind of wrap it up for you, we got through underwriting, we got to closing. The one thing I will say about the process for my wife and I, we are both small business owners, and because of that, there's just a lot more information that an underwriter in the mortgage company is going to ask us for, and they might ask us for it multiple times. And they might also ask you for it last minute. So there were a lot of things that they were asking for and requesting 24 hours before the closing date that we had scheduled for over a month. So that was a little stressful for us, but got them the information they needed. No, we did not make any crazy, outlandish purchases before closing on the house. And honestly, for me, I'm a little skittish about that and reserved about making purchases right away anyways. So we didn't make any purchases like the washer and dryer or a new refrigerator or anything along those lines until a few days after we had closed on the property. But the home checks pretty much all of our boxes, if not every single one of our boxes. So that was really important for us. It was still a good time for us to buy, even though interest rates are a little bit higher, certainly higher than what they had been the last 24 to 36 months. But it just made sense for us. So if you're in a position or a situation where you think it might make sense for you, feel free to reach out to me. I'd love to crunch numbers with you, for you, and get you connected with one of my preferred lenders, get you connected with the lender that helped me out for my purchase. I trust them. That's the reason that I'm connecting them with you. But hopefully this episode of Real Estate Simplified was one where you got some good nuggets out of it. You got some good information to consider as you are either purchasing your first home or keeping your current home, making it an investment property, and going and buying that next home. So until next time, I hope you enjoyed, and we'll talk again soon.